This video is about financial planning wherein you will be able to identify the tools in managing cash, receivables, and inventories. Working capital management refers to the efficient management of the firm's current assets and current liabilities. Working capital refers to the firm's current assets, which represents a portion of investment that circulates in one form to another in conducting the ordinary course of business. An example of this is cash being converted to inventories for sale, that is, eventually converted to receivables once they are sold on account and converted back to cash, once these receivables have been collected. While current liabilities are also part of the firm's working capital management, since these are short-term obligations maturing within 1 year or less. Most sources of current liabilities are obligations to suppliers for goods purchased, salaries to employees, and other obligations incurred as part of the ordinary course of business. While net working capital refers to the difference between the firm's current assets and current liabilities. If the firm's current assets exceed its current liabilities, the firm has a positive working capital. On the other hand, if current liabilities exceed current assets, the firm has a negative working capital. If we will be completing the picture, it will be good to serve that once cash has been converted to other forms of current assets and once again converted back to cash, it will be used to pay off maturing short-term obligations. Before we have the liquidity analysis, let us define liquidity. Liquidity is the ability of the business to pay its currently maturing liabilities as they fall on its due date. Comparing current assets and current liabilities assesses liquidity. While liquidity is most important to short-term creditors, it is also important to long-term creditors. This is because it is impossible for a business to pay long-term debts if it cannot even pay its short-term liabilities. Now, let us take liquidity analysis to the next level. A business purchases raw materials to manufacture the products they sell. Then, it will be paid either on cash or on credit. Once those products are sold, they are either paid in full immediately or are paid at a later date or a combination of the two. Ideally, we would want to receive the full payment of the sales right away and use that money to pay for the raw materials. However, the reality is that there is a mismatch in the timing of the cash receipts and the cash payment for the raw materials. Therefore, we need to know how long on average it takes for the business to pay its suppliers and to collect on sales. We will be able to answer that question through identifying the cash conversion cycle. It is also known as cash cycle, which is the time it takes for the business to collect on its accounts receivables after it has paid for its raw materials. The formula for cash conversion cycle is operating cycle minus the accounts payable period or the age of payables. To get the cash conversion cycle, we need to identify the operating cycle first. It begins from the time goods for sale are purchased to eventual collection of cash from the sale of these goods. The operating cycle of a firm is mainly composed of two current asset categories: the inventory period or age of inventory and accounts receivable period or age of receivables. The formula in getting operating cycle is age of inventories plus age of receivables. Therefore, we need to get or compute for the age of inventories and the age of receivables. Good Food Snack House balance sheets and income statement for accounting period 2013 and 2014 will be used as the basis for the examples for operating cash conversion cycle. Now, let's get the operating cycle for accounting period year 2014 by getting the inventory turnover first. So, the formula will be the cost of goods sold and then you will divide it in the average of the inventory. So, based from our balance sheet and income statement, these are the figures of our cost of goods sold and beginning and ending inventory. So our inventory turnover will be 4 days. Next, we have to take note the inventory turnover because we will use that in getting or computing for the age of inventory. You have to divide it into, or 365 divided by the inventory turnover, which is 4 days. Then we'll get the age of inventory, 91 days. Now, after getting the inventory turnover, we'll now get or identify the receivables turnover by getting the net credit sales from your income statement for year 2014 and the beginning balance and ending receivable balance from of year 2014 accounting period. So this will be the net credit sales, which is amounting to 7,457,736. And then the beginning balance, remember the beginning balance for 2014 is the ending balance of the previous year, which is 2013. So the receivables turnover will be 9 days. So the same with inventory turnover, we have to take note the receivables turnover in order for us to get the age of receivables. So 365 divided by receivables turnover, which is 9 days, then we'll get the answer 41 days. So our age of receivables is 41 days. Since we're able to identify the age of inventory and age of receivables, we will now be able to get the operating cycle. Since age of inventories is 91 days and age of receivables is 41 days, we get the total and then what that will be the operating cycle, which then explain that the business gets to collect cash from its receivables 132 days after it buys the raw materials. Meaning, the business will be able to collect payment from its sales after 132 days they purchase the raw materials. Next that we need to identify is the accounts payable turnover, which is defined as the time it takes for the business to sell its finished product from the time they are acquired. The formula to get the payable turnover ratio, it will be the cost of goods sold divided by the average payable. So, still we are getting the accounts payable turnover ratio of accounting period 2014. So the payable turnover ratio, if we will use this formula, will be 12 days. And then take note of PTR, which is 12 days. Now, the formula for each of payables is 365 divided by payables turnover. In our case, payables turnover is 12 days. So, we'll be able to get the answer 30 days. The business pays for its raw materials 30 days after purchasing them. Now that we already identified the operating cycle and the accounts payable period or the age of payable, now we'll be able to answer or get the cash conversion cycle of accounting period 2014. So, operating cycle minus accounts payable period, we have 132 days minus 32 days, then we'll get 102 days. With an interpretation of a 102-day gap between the time the business pays for its raw materials and the time it collects the payment on its sales. The question now is how to manage the operating and cash conversion cycle. We want to shorten operating and cash conversion cycle. To achieve this, ideally, you would want to collect the cash that is owed to you right away and pay your obligations at the latest possible time. However, the reality is that you need to extend some sort of credit to your customers to grow your sales and you need to pay your obligations a bit earlier to make your creditors happy. To manage these two cycles, actually, to shorten them, we need to manage their individual component periods. The first is the inventories. The objective in managing inventory is to convert it as quickly as possible to cash without losing sales due to stockouts. Therefore, the financial manager plays a crucial role in overseeing that the firm maintains an appropriate quantity of inventory. not too much and not too little. Maintaining too much inventory implies that the firm incurs more costs associated with carrying these inventories. However, carrying too little inventory quantities might lead to possible stock-outs that could further lead to lost sales and worse, lost customers. The next is accounts receivable or accounts receivable management. It represents assets of the entity that are expected to be collected and thus converted to cash. A firm would generally want to collect its receivables as quickly as possible without losing customers due to imposing very tight collection procedures. Thus, sound accounts receivable management practices would form three parts: the credit selection, credit terms, and credit monitoring. One of the popular credit selection techniques is the use of the 5 C's of credit. Sound receivable management begins with good credit selection practices, and in this phase, the entity determines who among its customers are credit-worthy, and thus deserves to be granted credit. This phase is critical because failure to identify credit-worthy customers would lead the firm towards selling to customers who won't even be able to pay at all. The first C is the character. Customer's track record of settling its obligations on time. The applicant's record of meeting its past obligations is judged. Second is capacity. Capacity of the customer to repay you. This emphasizes the customer's ability to repay its obligations in reference to its current financial position or standing. It determines whether the customer has sufficient resources or sources of funds that it can be used to settle obligations. Third is capital. Customer's level of capital in relation to its debt level. The applicant's level of debt related or relative to equity. The fourth is collateral. The value of the assets that the customer has and plans to use to secure the credit. This is the amount of assets the customer has that could serve as a security in the event that the obligation is not paid. Generally, the more valuable the customer's assets are, which could serve as a collateral, the higher the probability that he will be granted credit. And then the last is the conditions. This includes current economic and industry conditions that might affect the customer's ability to pay its obligations. The use of the 5 C's of credit will allow the firm to carefully assess the customer's ability to repay its obligations, along with the level of risk that the firm will be subjected to once it decides to grant credit to the customer. It requires experience in order to fully assess and review the creditworthiness of customers and subsequently make a decision. While liquidity is important, there is a price to pay for too much liquidity. A business that is very liquid, as evidenced by high liquidity ratios, might be considered not at risk of going bankrupt but is not being profitable. It should be noted that current assets are less profitable than fixed assets.